please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. 980 points actually on the Nifty. 11,315 is what we have. Ashwani Gujral is with us on the show, as always, on the top of 11:30. Ashwani, thanks very much. Your sense, is there more to go, or how does it look?
See, my sense is that something is not right, which means if on, say, Wednesday you were told you'll get 71.86 when you were at 73, I don't think people would have bet on, a hardly 70-point upside. Plus, financials fine. Yes Bank is not doing well. But, 160 points rally. So the market is not acting according to expectations at all. And what happens when you have a milder than expected, pullbacks, or the market is ignoring the good news? That means there is some sort of selling which is coming in earlier than expected. Now, reasons probably will follow, but I don't think this thing is going to sustain, and my sense is you could have a fairly bloody afternoon. Bajaj Finance can't rally 2 hours. HUL is coming off. You name the large stock and Jubilant Food is off. So this is going to collapse. Now, when it collapses today afternoon, Monday, that only time will tell. But this is not even 30% of what was expected. So definitely we'll take out Wednesday's low at some point. If you are long for some reason expecting, great short covering, get out. If you want to go short, put a high at the, stop at the highs of the day and wait for things to just collapse. Because, when large players cover shorts, stocks tend to build on gains. Here, the momentum on the downside seems to be increasing. Now, having said that, Wipro is a buy with a stop of 332, target of 346. DHFL is a sell with a stop of 606, target of 590. And Srei Infra is a sell with a stop of 46, target of 40. I don't know, but maybe it has something to do with this ILFS issue, etc. Because this is very funny the way things are just breaking down.
Ashwani, good morning, and morning to you from your city today. I take your point. I'm noticing the selling on Jubilant quite a bit. Godrej Consumer, by the way, let's pull up some of these stocks because they're all struggling quite a bit now. Godrej is also well off the highs. By the way, the cut on United Spirits has gotten even deeper. We're talking a decline of more than 6% now. And a lot of sugar is selling off. So the sweetness is definitely off on stocks like Triveni, Dhampur, Bajaj Hindustan, etc. On the larger stocks, Ashwani, since you're negative on the market overall, I mean, would you, for instance, look at shorts even on the biggies, whether it's Lever or even something like a Bajaj Finance for that matter?
Absolutely. Who's selling Lever on the first day of a pullback? I mean, what was happening on Wednesday is restarted, and chances are post-noon the intensity will only increase. I mean, where would you have expected short covering first? Where there were those big shorts and, the big guys, the future stocks. This means that, whoever wants to sell cannot tolerate even a 2% rally on any of these stocks, and is now, the stocks are making lows of the day. See, the message of the market is clear. Now, we can ignore it, keep repeating about the rupee, but I don't think the big players are really bothered about the rupee rally right now. They want to sell while they can.
Okay, we're watching the screen because first signs of weakness are beginning to creep in this morning. Nifty is still up, but it's well off the highs. In fact, in between, when we took that break, we were trading below 11,300. So that's the battle zone for now. Bajaj Finance, Ashwani already pointed out, pull up its twin, Bajaj Finserv. These are stocks which are beginning to get a little wobbly. The cut on Yes Bank is 21% as we speak. And of course, Lever, Titan. These are some of the other big names on the Nifty that we must keep in mind. So let's just see how this plays out. The mid-cap index is already negative, by the way. Okay, on that note, let's move forward and get our next market conversation going. Jyotivardhan Jaipuria, founder and MD of Valentis Advisors, is with us. Jyotivardhan, thank you so much for joining in. Good morning to you. So it's been a bit tricky last couple of weeks for the market. The rupee, CAD, oil, etc. And of course, overall emerging market risk aversion. First of all, first up, simple question, is there more downside?
Yes, I think there's more downside. So, last time when we had this conversation, I said I think that the markets are quite expensive and we were expecting like a 5-7% pullback at least on the markets. I continue to hold that view. We've seen some correction come in since we last spoke, but I still think there's more downside to it because, markets are looking extremely expensive at this stage.
Interestingly, Jyoti, what is happening in this leg of the correction is that the strongest stocks are beginning to feel the heat. And that's making people a little nervous. And I'm talking about big financials. I'm also talking about India consumer. I mean, who would have thought that lever will fall the way it's falling? Your thoughts on the bigger parts of the Nifty that are beginning to see some stress?
Yeah, so, we again had discussed this last time that, the first leg of the correction came in the mid caps and, the mid caps had become expensive. Relatively now mid caps and large caps, the divergence has come down quite a bit. So I think going forward, we are not going to see that big divergence between the two. I think both will correct more or less in equal proportion. Consumer staples is one area which we find very expensive. We spoke about it last time also that we think it's expensive. And though, these are all good quality companies, the price we are paying for it today is too high relative to their past history, relative to the market and relative to the growth prospects we have. So that's one area we are negative, not because we don't like the companies, but because we think, they are just too expensive.
Jyoti, hi, morning. Prashant here. Your thoughts on what's going on with Yes Bank?
So, Prashant, without getting into stock specific, there are two things with the RBI has been doing. If you see, all the banks where there's been a divergence between what, they think is the NPLs and what is reported, they have been quite strict about it and they have been sending the signal that this needs to be met, the divergence can't be allowed to continue. And in light of that, I think they've been quite consistent that if, they have not seen the remedial action come through, then they're not allowing, the CEOs to continue. They are, wanting their term to be cut. So I think it's a signal from RBI that, they want to be quite strict on what they think is the NPL scenario, which I think longer term will be very good for the banks because then, you'll have more comfort that what is reported as NPL is probably the actual NPLs which are there.
Okay, all right. But nothing more specific, Jyoti? It's down 20%. Does it?
Yeah, so it's again...
Yeah. Go on.
See, in all the banks, it's like, do I believe the numbers which are there on the books? And if there's anything which starts creating a doubt on those numbers, where you start thinking that maybe the NPL provisioning required is more than what is on the books, then, everybody starts to get nervous. And it's not just an India phenomenon, it's a global phenomenon, right? Every time there's a doubt that, okay, maybe, there's some part of the NPL is hidden, then, investors get very worried and they start hammering the stock away.
Okay, what are you doing, Jyoti? I mean, I think it was July when we spoke, you said you're looking at cement, pipes as a sector is something you mentioned, the electrification theme, transmission towers. Sticking with that?
Yeah, sticking. So we've not really changed too much in our portfolio. We've been sticking to it. Even last time I mentioned we have cash. We're still sitting on cash. We're nibbling stuff on and off because, there are times where the markets correct quite a bit. It gives us some opportunities. We've got into some names probably in the consumer space, not exactly in the staple space, but more, consumer discretionary because that's one area where things are not as expensive. We keep looking at, suppliers to some of these companies which are growing strongly and they trade at much cheaper levels. So there are a couple of outsourcing, there are a couple of companies which supply to all the big consumer staple names which are trading much cheaper, and those are the areas we are buying.
Okay. Jyoti, finally, a word on NBFCs. Let's pull up Bajaj Finance. I mean, this stock has lost about 17% from its peak. A lot of that correction has happened in September itself. So the question is this. Now, either this is a great buying opportunity on some of these marquee NBFC names, or the market is pricing something far more serious. Now, whether it is in the form of an IL&FS issue blowing up, or whether it's just very high rates from here on, high yields, which camp are you in? Is this a buying opportunity for NBFCs, or absolutely stay away because there's more on the way down?
Yeah, so see, if you look at the NBFC story, the 3-year, 5-year story is very simple, right? That they will keep gaining market share in terms of the whole lending pie because probably the public sector banks are going to keep losing market share. Second is they are catering to a lot of the smaller consumers, which both the public as well as the private sector banks may not be nimble enough or may not want to operate in. But near term, clearly there is pressure because of two things. One is because of the way the stocks have performed. They are no longer cheap. At some point, there were easy pickings there, but now stocks are priced to perfection. And second is the environment for these NBFCs very near term is interest rates are rising, and because of that, they will probably struggle a bit to maintain NIMs over the next 3 months, 6 months. And so I guess, people are looking at what are the good entry points to come in. We are keeping a watch on some of them. We in fact bought a bit in one of those things which have come up quite sharply. But everybody would be happier if we get some of these things cheaper and we can then buy it for the next few years.
Got markets which are up 62, 11,297 is where we stand at this point in time. Well, the one sort of segment which you can count on, be it a bull market or a not so bullish market, is the consumer, the Indian consumer, and the potential for the Indian consumer to consume in the next couple of years, the next couple of decades. Bernstein's Venugopal Garre has come out with a magnum opus. I mean, he's calling it a black book on the Indian consumer appliances sector. Venu, thanks very much. Great to have you with us here on the show. If you can first up lay down what you've done here in terms of the research. What are you looking at? Which are the end markets we are focusing on when we talk about the consumer appliances space, and the key findings?
Yes, Prashant. So, in fact, what we tried doing here in this black book is trying to give an identity to this sector, especially because you know that when we talk about consumer appliances, this is not one end market. There are numerous end markets, starting from a simple product like cable wire to complex products like air conditioners and refrigerators. So the identity to the sector is what we tried creating in this black book. But interestingly, each of these end markets, which are more than 20 product categories, have different sort of demand rates, tend to be quite volatile when we look at near-term factors, etc. But if you look at the overall size of the market at this juncture is $20 billion. Now that's a fairly small size, but then over the last decade, we have seen this market grow at more than 15% CAGR. So from a very simple top-down perspective, when we look at this market, what we are saying is that, look, over the next 20 years, if we are looking at a 9 to 10% growth for this market, this is essentially heading into a $100 billion annual per annum opportunity over a 20-year period, and something like a $50 billion over the next 10 years. So the market is going to scale up, and that is what is going to provide opportunities for vendors. But at the same time, the argument one could make is, are there any examples from a global perspective on similar markets which have seen extended periods of growth rates? So when we look at China, where we've done extensive work, especially in this black book, where we highlight that, look, the China market as it stands today is more than 8 to 10 times that of India. And more importantly, we have seen almost 10 to 15 years of 20% plus growth for a lot of companies in that space. There are more than 5 companies with $10 billion revenues at this juncture, while the largest, probably the Indian company, which is an aggregator of these 3 end markets, which is electrical, small appliance and white goods, is Havells is just about $1 to $1.2 billion revenue sort of a metric. Now what we're saying is that, look, if we sort of triangulate the sort of top-down thought process that we have, and look at some interesting metrics over the next 10 years, which could be the key things which could drive the sector. One of them being essentially the fact that if you look at affordability versus penetration curve, this is probably more pertinent for white good products where penetration is low in India. They tend to follow a very nice pattern if you do a global comparison. So our view is that over the next 5 to 6 years, you will reach tipping points for some of these end markets, which could be air conditioners, refrigerators, etc., where you would see lift off in growth rates. And the second part being that, look, in the last couple of years, we've seen housing market being weak. And that's an important underlying driver for quite a few of these products. So over the next 5 to 6 years, we think there would be a recovery in housing market again, which essentially again lifts or potentially provides a cyclical lift to this sector. So the thought process hence, when it comes to the overall market sizing perspective, is that this is a market which is going to provide opportunities for growth for the Indian vendors.
Okay, fair enough. an interesting comparison, right? I mean, 4 to 6 consumer appliance companies in China with revenues of in excess of $8 to $10 billion. The largest one here is 1/10 the size of those companies here, which is Havells you referred to. But there are many listed here, right? I mean, there are one product companies, single product companies, two product companies that are big aggregators. What should one do to play this opportunity? I mean, what should long-term investors do? Buy a bunch of them, sit on them? Or you think it's already time to kind of sort of sift through, try and pick out the winners? How would you look at it?
That's an interesting question because it happens in every end market. And I'm sure you would have seen that in the IT boom days to construction boom in the mid-2000s, as well as power sector, for example. So whenever you smell an opportunity, when you see a sector scaling up, and you see a leader like Havells having delivered over the past decade, and when people see them doing well, there is a host of companies which try following similar strategies. Now, everybody wants to be a multi-product category company. They want to sort of launch products into adjacent end markets, etc. But the interesting thing is that in the initial phase, when 15, 20 companies try doing that, some of them tend to get growth because they tend to displace the so-called unorganized players in the market, right? And plus, they have their existing product base, which is their core revenue stream. But then what happens essentially is after this initial scale up, we think that if you take a 5-year plus or a 10-year view, this is not essentially a market growing at 30-35% growth rate per year. So what it essentially means that while there would be room for a few players to sort of emerge and sustainably scale up, and not all of them. So interestingly, what it essentially means is that when you look at sifting or trying to identify companies which could be long-term winners, you end up taking some qualitative bets. Now, what we do here is that we say that, look, what we need to understand is what are the key variables which essentially would make me pick a company. In this market, we think the brand is extremely important, and it is about wide reach of the brand, right? And more so, distribution presence have to be a pan-India product. The understanding of the product for the company is very important, and more importantly, the managerial bandwidth, their capability, and their track record. So when we sort of put all these soft filters across more than 20 companies that we sort of track in this sector, we came up with 3 names, which is Havells, Crompton, and Voltas, which we thought in individual markets, because Crompton is a consumer electricals company, Voltas is a white goods company, and Havells sort of straddles all 3 end markets, including small appliances. Our view was that, look, these 3 have the best chance of sustainably scaling up. It does not mean that some of the tier 2 or tier 3 vendors that I say today do not have a potential for scale up. But at this juncture, we feel that these 3 are the ones which we should essentially look for a long-term perspective, and maybe a couple of years down the line filter down to 1 or 2. So that's a way I would approach it. But if you're taking a long-term call, it's best to identify and do work on these 3 names.
Fair, Venugopal, got your point. And just a quick question: what are the risks to those projections? I mean, I don't know. Could it be Chinese competition? Could it be internal India market competition, where then it starts impacting pricing at a level? Any risks to that outlook?
See, if pairing the so-called near-term demand volatility and risks which keeps happening from time to time, I think the interesting thing you raise about is Chinese competition and competition in general. See, normally what we have seen, these end markets tend to be fairly fine in terms of competitive activity, which means that you don't really see any disruptive competition or disruptive pricing paradigms entering this market. And this market is very different from, let's say, a mobile phone or a consumer electronics market, where the Chinese vendors have entered. They now command 50% market share in the mobile market, and we do expect them to succeed in the television market too. But there, the entire paradigm is different, because those are products with short product life cycles, and the value equation that they provide there, with product prices essentially 50% of that of a leading brand and offering you a similar value, there is a very different argument there. But when we look at these end markets, essentially consumer electrical end markets, this is primarily dominated by Indian vendors. You don't really see any disruptive competitor enter this sort of a space, except for lighting market, where pricing stability has not happened as yet, and that's the reason why you tend to see some competition there. But when it comes to other markets like white goods, we don't really see much of the Chinese vendors essentially creating a dent at this juncture, because all our consumer surveys that we tend to do in that part of the market, the feedback we get is that there is a willingness to pay a premium of 10 to 15% in terms of pricing, because they want to hold the product for at least 8-10 years. So replacement cycles are fairly long there. So that's a reason why you don't tend to see any disruption happen in this end market, even though I would say that my worry or risk probably will start when this market scales up significantly a decade later, where it would probably be a stage where you tend to see competitive activity accelerate.
So we start wrapping out of trading hour. Two themes are very clear today. There's pressure on financials, particularly NBFCs, and there's intense pressure building up on consumer stocks once again. Let's just pull up some names. Look at Jubilant Foodworks now. The cut there is quite apparent. We're looking at almost a 4% drop on Jubilant Foodworks, and it's not alone, because whether you're looking at Godrej Consumer or you're looking at Dabur or a Lever, it's the consumer stocks that are really beginning to feel the heat. And obviously, there are the Bajaj twins in the frontline pack. So Bajaj Finance, the stress there continues as well. Let's see what the next half of